Sure. So I've had contact with Hound Resources. We finally did get some arrearages. So the 12,000 we received in December was for some of the back 2021 royalties, but we've still got months and months and months that they haven't paid us yet. So I'm giving them about 45 days from when we got that last check to see if we get another one, and if we don't, I'm going to call them again, and we're going to have a little more of a powwow about this and why it's taking what it is. So, but I think that's at least progress. So that's where we're at with that.
What kind of leverage do we have with them to make those royalties checks come to us faster?
We don't really have any leverage at all, except for, I think at some point there, we'd have to involve George, and there is I think it's the Office of Mineral Management at the state level, but they do a lot more with the permitting and the regulating of the wells, and occasionally they'll do audits of royalties, but I don't know how much teeth they have in this matter. But we'd probably start with George if we're not getting any satisfaction, probably have him send them a letter and then go from there, but we're not quite to that point yet, but we're getting close, I think.
Okay.
Okay. Do you have anything? Okay. Approval of minutes from October 26, 2022.
I'll make a motion to approve the minutes as presented.
Second.
All in favor?
Aye.
Opposed? Motion passed.
Investment advisor update and commentary.
Looks like they're joining right now, so let's give them a second.
Woody, just talking.
Can you hear us, Woody?
Right.
He's muted.
Woody, you're muted.
Hello, Manistee.
Hi, Woody. Can you hear us okay?
I can, yeah.
Hear you just fine.
How's our sound?
That's great. We got it fixed on our end, so it's much better than it has been.
Good, good. Who all do we have in attendance today? I can't see because the camera's at kind of a distance.
Yep, so we've got Councilmember Beaton, Mayor Sullivan, Doug Parks, myself, City Manager Bill Gamble, and Executive Assistant Kelly McCall.
Great.
And Aaron Pontiac, right, is that the other member?
No, Jeff.
Jeff.
Rowe.
Jeff Rowe is not here.
Okay.
I don't know, Woody, do you wanna share the screen, or do you want me to just pull up the slides and go through them as you're talking? What works best for you?
It's up to you. I think if you have the printed booklet in front of you, it might be easier because it looks like the screen is behind the members of the board. So whatever you want to do.
You guys all have the printed copy or not? Okay, we'll just go through the printed. Everybody has it.
Okay, good. Well, let us know when you want us to launch. I know you have some other business to attend to sometimes, or usually, at least according to the agenda.
Yep, so we're ready for your presentation. We already did A in the old business, so we're on to B, investment advisor update and commentary.
Okay, great. Well, thanks for having us today, and we will go through our usual presentation, which should take about 20 minutes or so without comments, and we welcome questions or comments anytime during the presentation. And we'll start off as we normally do with a review on page 4 regarding an overview of the capital markets and the economy. And I'll kick it off and then let Brian Walker and Troy Snyder chime in with their own comments. We have about 4 or 5 pages here. We have the summary page on page 4, and then we have some charts that support those comments. And we'll start off with just kind of some overarching observations about what's happening. It's fair to say that, as we've mentioned in the last couple of meetings, that inflation is the dominant factor influencing the markets and the economies today. It's what caused the inflation that we have, and the perception or the expectation as to what inflation will trend to over the next 2 or 3 quarters. We've seen in the markets over the last probably the last 3 quarters, you've seen some evidence in the last few months of inflation subsiding and the markets being very volatile on the upside. The market is very fixated on these inflation numbers, and if they're positive, in other words, trending down, the stock market reacts very positively, and the bond market. But if they're level or flat or trending up, there's a strong negative reaction, and so that's really kind of percolating throughout the world, and we're going to continue to see that, I believe, over the next 2 or 3 quarters. And so we also have a few other comments here about stocks. The good news about the stock market is valuations, as we'll see in a moment on one of the charts, are much more reasonable than they've been in several years. And that means that stocks are more attractively valued than we've seen for a while. We now have bond returns that are more normal. We're getting back to the 3 to 4 to 5% types of bond yields, depending on when they mature and how safe they are. That's a more normal level. And we generally have a fairly strong economy. Economic growth is still positive. Unemployment is very low and likely to stay somewhat low. And we always have these hot spots, like we have right now in Ukraine and Russia, issues with China, COVID, those kinds of things. But with that, I'll turn it over to Brian first, and Brian might want to refer to some of the charts here, maybe not some of the interest rate one, because maybe that might be something that Troy might want to chime into. But take it away, Brian, with anything you want to refer to on the charts. You're muted, Brian.
Yeah, sorry. 2 of us now. Apologize for that. So if you flip to the next page 5, we have a chart on inflation, and we've continued to review this the last few times we've met, but since we had our last meeting, there has been significant positive progress, and so I'm happy to show that. The green line shows the current CPI inflation reading, and we had a pretty positive reading that came out 2 Thursdays ago, and the most recent inflation reading had continued to drop pretty significantly to 6.5% year-over-year inflation. So it's obviously still very elevated, but significantly lower than we were back in March and April of last year, where inflation, at least for this reading, topped out above 9%. So very positive to see that moving in the right direction, and that really has a lot to do with why the market's been so much better going back to October. We had one bad reading in August or September that kind of caused a short sell-off in August and September, but markets reacted positively to this trend continuing to improve. One thing that's not here on the chart is that 6.5% inflation includes housing prices that are still increasing 7.5%. So this measure is looking in the rear view mirror and looking at housing transactions over the last 12 months. And we know that the housing market has significantly slowed down since July. And that's not really fully baked into these CPI numbers. So inflation, really is quite a bit better than what these headline numbers show, which in turn means that there's less pressure on the Federal Reserve to continue raising interest rates. So Troy, being the bond manager, may have some further comments on that, but I'll maybe let you, Troy, comment on the next page, which is the yield curve.
Thanks, Brian. Hello, everybody. 2022 was obviously a tough year for certainly equity returns, but bond returns were impaired by rising interest rates. And this chart on page 6 shows just how high interest rates moved during the year. You can see beginning at the beginning of 2022, interest rates, Fed funds rates were still close to zero. And in fact, the Fed didn't really start raising interest rates until March. So that blue line was with us for most of the first quarter of 2022. And then suddenly, of course, interest rates went up with 7 rate hikes. And you can see where we ended the year on the green line. So interest rates, with the Fed raising short rates and the expectation that inflation's coming down, some of the longer rates have begun to already account for that and have started to come down. You see there, if you move out to the 10-year, you see a 388 number on that green line. That's more like 350 now, just 3 weeks into January. So interest rates, the longer interest rates have already discounted more Fed hikes, having a bite in the economy, meaning that at some point they're going to actually slow the economy, maybe raise the unemployment rate a little higher than where it is now, and maybe get inflation moving in the right direction. They want it to be 2%. We're still a long ways from that. So a lot of experts are, we need to pause here pretty soon and let these higher rates have some time to work. And I think you're probably going to hear more about that as the year unfolds. Looking for the Fed on February 1 to raise rates at least another 25 basis points. And then if inflation continues to stay in that 6 to 7% range, it's very likely they would raise rates again at the next meeting. So still not out of the woods in terms of rising interest rates from the Fed, but all indications are that they're having a bite, and especially the way longer interest rates are trading, the expectation is that the Fed is having some success. So this is what we're working with now. As a bond manager, I have to say these are much better interest rates to invest for the bond portfolio. So it's been kind of a little bit of a fresh look here at interest rates and helpful to the bond portfolio.
Troy, give us some historical perspective on the performance of the bond market last year.
Oh yeah, the returns that we'll look at here shortly are really epic in nature for the bond market. When you go back to the 1970s, you had some of these kind of return numbers when interest rates were going up at a pretty good clip back then. But these are really probably the most negative bond return for 1 year that we've really ever had. There were some periods in the 70s, as I mentioned, that were close, but this was a pretty amazing year in the sense that interest rates going up so fast and so far really had a pretty major impact on the negative returns that bonds experienced. And of course, that's all price driven, and it's somewhat temporary. As the bonds mature, those prices will gradually come back to their par value. But nonetheless, the damage was there during 2022. And the one that, in terms of history, Woody mentioned, historical perspective. When you look back at periods of very severe underperformance by bonds, they tend to be followed by fairly good periods of bond performance. The bond market sort of overshoots and then it kind of corrects. So we're off to a pretty good start so far in January with interest rates coming down further. And so we're seeing some nice positive returns for the first 3 weeks of January. In fact, the fourth quarter was good for bonds. So this has been going on for a little while now.
Troy, I have one question for you. So,
Yeah.
from what I've read, the Fed is probably going to slow the increases in terms of their magnitude and maybe stretch them out a little bit. But are they still? Is it still looking like 250 basis point hikes, you think, or what do you think the future is going to be? And how long do you think this yield curve is going to remain inverted?
I think the curve will be inverted until we see a very significant recession, and that causes the front end of the curve and the Fed to lower interest rates. So I think we're probably a pretty good ways out before we see the front end of the yield curve, those high 4% yields, come back down, unless the economy just hit an absolute air pocket and, we had a problem, But, the Fed is, the one thing about 2022 that was much different than 2023 that we're about to see, there's going to be a lot of uncertainty this year about what the Fed's going to do. Last year, with inflation so high, everybody was a perfect economist. You could predict that the Fed was going to hike rates. You knew it was going to be a big hike. As we go through this year, it's going to be not a consensus type number as we get into this year. People are going to try and guess what the Fed's going to do. And when you look at the committee members are out talking about what they're going to do, and they're kind of all over the board. So you've got some thinking it's time to pause, some thinking at 25 is enough, and some thinking, yeah, let's just get that 50 out of the way and keep going. So I think there's a lot more uncertainty about what they're going to do. I think the general consensus is a couple more hikes, maybe 25 is enough, and maybe then they'll pause for a while.
Thank you.
Yeah.
Let's take a peek at page 7. And we mentioned a moment ago that stock valuations are down to more of a median type average level. And this chart goes back about 60 years plus. And probably the best metric to assess the level of the stock market in terms of either cheap or expensive or, overpriced, undervalued. We have on this chart overvalued, undervalued, but the best metric is the price earnings ratio. And that's what we see here. And at extremes, it means a lot more than when it's in the middle. And so when it's in between the dotted lines, it probably doesn't mean as much. But when it gets above those dotted lines, it's suggesting that the market is overvalued or undervalued. And so right now, we're kind of in that middle territory, and that's probably a good place to be. But it does give us a little more encouragement that the stock market is, fairly valued, more likely to get, better returns. Any questions? Any other further questions at this point? Let's turn to page 10, the asset allocation. Brian, do you want to pick up and just kind of give an overview of 10?
Yeah, sure. Thanks, Woody. So page 10, you can see the current asset allocation. This is as of the year end. So on the, I guess maybe focus on the table first. Equities, we're essentially right in line with the target, about 65.8% equity versus a target of 65%. You can see the breakdown there between domestic and international stocks. Fixed income, we're also exactly on target in terms of 30% versus the target. And then we have the cash balance there of 485. And total portfolio value, including the loan, of just about 11.7 million.
Brian, quick question. Do you know what we're yielding on our cash right now? Are we in like a money market that's up over 4% or something?
Yeah, the Schwab money market's yielding 4.3,
Okay.
4.2% today.
So that's going to give a little boost. We haven't seen those returns on cash like that for a long time. And I mean, we're seeing that in the city's operating portfolio as well, so.
Yeah, and just like we saw on the chart earlier, if we were sitting here talking a year ago, that cash on that same money market might have been 5 or 10 basis points, and today it's 430.
So it looks like you guys have positioned it kind of, I wouldn't say, conservatively versus the target, but at the target, so you can be opportunistic as the market conditions kind of warrant.
I think that's a fair statement, Ed. Yeah, we let the cash kind of stay up on the higher end. It's with the capital expenditure budget, we don't want to be out with long-term securities as we have to raise money, maybe in the spring. So some of that's driven by that, but certainly in this market now, as Troy would say, we're not opposed to owning a money market fund where you're getting yields that might be higher than bonds in many cases.
Yeah.
That kind of is a good lead in to the next page. Troy, if you want to make just some summary comments on page 11.
Sure. So on page 11 is a profile of the bond portion of the portfolio. The table in the upper right-hand corner, the column under the city of Manistee, you see there the average maturity, a little over 4 years. The yield, 4.2, that's up tremendously from a year ago. And the average credit quality, AA minus. And so you can see a couple other columns there. Those are bond benchmarks. The primary bond benchmark is the one in the middle, the Barclays Gov Credit Intermediate, and we're pretty close to that. The other one on the far right is a 100% corporate bond index. And last year was not a good year for corporate performance as we moved into all the uncertainty that higher interest rates and higher inflation brought. Corporate bonds had a very difficult year. They're doing a little better now, but that was a pretty tough year last year for those. To the left there, you'll see the maturity distribution. City's portfolio there is in the green. And the nice thing about this distribution is when you look out to about 5 years, that's about 2/3 of the bond portfolio will mature relatively soon and be available to be reinvested at higher interest rates that we have now. So that's one of the main benefits of an intermediate bond portfolio. To the lower left there, you'll see that corporate bonds make up most of the portfolio, although treasuries are another significant portion. And then agencies and mortgage-backed securities are a smaller portion. And then to the lower right, you'll see the credit quality distribution there. Very high quality. The treasuries are the AAA for the most part. The mortgages are AA. There's a few corporates that are like that. And then the A and the BBB bonds are mostly the corporate bonds. So overall, a high credit quality and well diversified. And the portfolio provides pretty reliable income and growing income now, finally, we can say, with these higher rates to help complement what Woody and Brian are doing on the equity side. Any questions on the bond portfolio? Okay.
The next page shows the equity sector allocation as the Manistee Oil and Gas Fund is diversified within the stocks by these industry sectors. And as you can see along the bottom, the Standard & Poor's 500 has 11 different industry sectors. And you can see the comparison of Manistee versus the Standard & Poor's 500. We're a little overweight in healthcare, which we like because it tends to be a more defensive type of industry group. It's not as sensitive to the economy, and therefore it's not as volatile in the stock market. And that's a good place to be, where you get good returns, good businesses, good dividend yields, good growth, but without the volatility. And we're a little lighter in technology, but generally we're somewhat in line, except for energy. We're underweight in energy, which also tends to be over a pretty volatile sector. The next page is the cash flow additions and distributions. And you can see the beginning going back to '08. And actually, I think it was '09, but it was the fiscal year. I think that's always a little confusing. I think we started, Ed, I think we started in early March of '09, I recall, but that might have been fiscal year '08, technically. But you can see the various numbers, oil and gas royalties, distributions.
Woody, I think there's a typo on 2021. I don't think that included the cash that we had on hand, so I can get you that updated number. It was higher than that.
Okay.
If
The,
you
which
wanna,
column?
if you wanna run those past me before we publish this stuff to give a second set of eyes on it, I'm happy to do that.
Yeah, yeah. What number on that 2021?
I have to look it up. It's up over 400,000. I think we took out about 50-some thousand.
Okay.
That we had cash on hand to make up that total, but I can get you that number.
Okay. Well, I always find this kind of interesting, and I've mentioned this in the past, that the total distributions now are approaching what the value of the fund was when we started in '09, getting very close. I think the next time we do one, we'll be over the top and having taken out more in 14 or so years than what the fund was worth in the beginning. And hopefully this spending rate will allow us to, the golden goose, to keep delivering. Brian, you want to make some summary comments on the performance page?
Yeah, sure. So page 15, you'll see the performance. We have this through the end of the year again. And so obviously very tough year. One of the toughest years for balanced accounts, accounts with stocks and bonds that we've ever had. So year to date, or for 2022, portfolio is down 13.6% with fees. And how did that compare to the market environment? The S&P 500, including reinvested dividends, that's the total return if you look down below, was down 18.1%. So I believe that was the worst end of the year that we've had going back to 2008. International stocks did just about as poorly. That MSCI All Country World Index is everything. It's outside of the US, down 16% with dividends reinvested. And then the bond market, the next line, the Bloomberg Intermediate US Government Credit Index, was down 8.2. A broader benchmark of US bonds, the Barclays aggregate, was down 13%. And so it's just a very unique year. Typically when you have the equity markets down that much, the bond market is a ballast in those years, and because of the interest rate and inflation environment that we discussed, that was not the case last year. So I think the account held up relatively well given the market conditions. But I think importantly, looking back on the longer term returns, that say for instance, looking at the trailing 5-year, the equities on average have still, even with this past year, returned 9.6% annualized, and the account overall is still up 6% annualized, including the fixed income. So we know we have tough markets like this here every so often, and it doesn't change our investment strategy.
So Brian, am I reading that right? For the trailing 5-year, our equity portfolio slightly outperformed the S&P 500, 9.6 to 9.4, is that correct? I'm reading that right?
Correct.
That's hard to do.
Well, actually, Ed, if you factor in that we have an allocation in the policy statement and in the portfolio to foreign, the foreign was up 0.9. So when you factor that in, that we've got this about 15% of our stocks are foreign stocks. So that created a little more of a drag on the
Sure.
overall performance. You see that number, 0.9% for the 5-year on the
Yeah.
MSCI. Other thoughts? Madam Mayor, any comments,
No, sir.
observations?
Well, I think you've answered all our questions, Woody. And Woody and team.
Well, always a pleasure to be of service and to see all of you now. We like these Zoom calls, by the way. Doug is very studious there. I've seen him just scribbling away on the paper and taking notes.
I think we're gonna try to the extent that you're not here in person, we'll try to do them via Zoom, and we'll try to include that on the, to give you that information more in advance, so. Sorry about the last minute, but it worked out well. We're meeting up in the
Yeah.
council chambers now, so we can record the meetings, and we have better sound system, and it works out well.
Good.
Great.
Okay.
All right, thanks, gentlemen. Have a good rest of your day.
Thanks, everybody.
Thank you. You as well.
Thank you.
Bye now.
Appreciate it.
Annual spending rule calculation.
Okay, so I included in your packet the annual calculation of the spending rule. It, again, looks at the 12-quarter moving average of the ending value of the portfolio, and it uses a 3.5% sustainable spending percentage. The calculated amount this year is 433, which is up about almost 11,000 from the last year amount. And that might seem surprising if you look at the last 3 portfolio values as of June, September, and December 2022. You can see they've gone down as the stock market has declined. However, if you look at the ones that rolled off the front end, they were even lower than that. So that's why that number has gone up. And that's the entire purpose of this calculation. This is a great illustration of it. It smooths that out. We're not just basing the calculation on one point in time at the end of the value. And so that helps control the ups and the downs, and it keeps this capital distribution kind of in a steady range so that the city's budget isn't unruly disrupted. So it works out fairly well. So that's the amount that we've calculated, and that would be the amount if we accept this to be in the city's capital budget for fiscal year '24.
Annual review of bylaws.
Do we want to accept that for this upcoming year? Because I just would need a
With
motion.
3.5, it's actually more dollars in our pockets than the prior year, so it makes sense to me. We might as well.
So I just need a motion, a second, and then,
I'll make a motion.
okay. All right, all in favor?
Aye.
Opposed? Motion carried.
Annual review of member roster.
Did we do bylaws, Mayor?
We just do that?
That was the,
Oh, I'm sorry.
Yep.
I just said it.
That was a
Okay.
calculation,
I'm
sorry.
Okay, annual review of bylaws.
I don't have any comments on them. I think they're fine.
Okay. Is that a motion?
I don't know if anybody else had any comments.
Like mine changed, but do we need to?
I think so. Was that covered when we?
I don't
did
think
the-
we need to, I
when
mean,
we
if we're
did
not
the
gonna make
real-
changes, we don't need to have a
It's
motion,
on
but
boards.
we're not recommending
You know what
anything
I'm
to
talking
council.
about, the committee assignments.
Did we? I believe so.
Okay.
So no changes?
I don't think so.
Okay.
I think we're okay then.
I don't think we need a motion then because we're not recommending anything to council, so.
I think the only thing that I just spoke to Linda before, but it's not in here, so I don't know if it needs to be, is changing the times of the meetings. I didn't see it in here, so I don't think that it needs to.
Right, I don't think it necessarily, if it's not in the bylaws. I think in the bylaws set how many times a year that we want to meet, but
Okay.
the times we can be flexible with.
So do we need a motion to accept it?
Not if we're not making changes outside
Okay.
of, so we could just leave it.
Kelly, I will notice one thing here. It does say, meeting times and locations shall be posted and open to the public with time set aside at each meeting to receive public comment. So we probably ought to add public comment to the agenda for meetings moving on. I didn't notice that before. Not that we ever have any public here, but
Right.
just something.
I'll add it, sure.
Well, I'm sorry, there's public comment at the end. I don't know if we need it in 2 spots, my bad, sorry. Oh, it's there.
Then I think we're good.
Good to keep going? Okay. Annual review of member roster. I'm good with it.
Everybody's looks good, okay, no changes then, we're all set.
Anybody else have anything? We have no public comment, so I'll take a motion to adjourn.